January 2008, Omaha, Nebraska. A 77-year-old man picks up the phone and bets $1 million against Wall Street itself. Not on a stock, not on a crash. He bets that a fund with no stock picker, no predictions, and no star manager will humiliate a hand-picked team of the smartest money managers in New York. The professionals get to choose any hedge funds they want. He gets one boring index fund. That does nothing for 10 years. Winner takes all, with every dollar going to charity. In the next 90 seconds, you will watch that bet end in the most public humiliation in Wall Street history. And it opens 5 boring secrets Wall Street makes less money telling you. Secret number 3 is a single percentage point that quietly eats a quarter of everything you will ever save. And secret number 4 is a study of 66,000 households that found the hardest working investors earned 6.5% less every single year than the people who did nothing. Ask the internet where to put your money, and you will drown in loud, exciting noise. But in investing, there is a pattern nobody points out. The louder the pitch, the worse the average outcome. It is the one arena in life where doing less reliably beats doing more. That is not a slogan. It is arithmetic, and it starts with how the $1 million bet ended. Secret number 1. The professionals already lost. Publicly. The man in Omaha was Warren Buffett. The firm that accepted his bet was Protégé Partners, professional fund selectors whose entire job is finding winning managers. They chose 5 funds of hedge funds. Behind those 5 funds stood more than 100 hedge funds, run by some of the highest paid investors alive, free to trade anything at any time, in any market on Earth. Against all of that, one S&P 500 index fund, a fund that simply owns 500 of America's biggest companies, and then does absolutely nothing. 10 years later, the results were read out. The boring fund, up about 126%. The professionals, an average of 36. Not one of the 5 expert portfolios beat the index. An entire skyline of genius, out-earned by a fund with no stock picker. Now, one bet could be luck. But the next secret is measured across thousands of funds, year after year, and the pattern keeps coming back. Secret number 2. 9 out of 10 professionals lose to average. Every year, the company behind the S&P 500 publishes a scorecard. Professional fund managers versus the plain index. Over any 15-year stretch, roughly 90% of professional U.S. stock funds fail to beat it. Sit with that. These are people with finance degrees, Bloomberg terminals, and teams of analysts working 70-hour weeks. 9 in 10 lose to a fund that picks nothing. And the reason is not stupidity, it is structure. Call it the cost gap. The market's return is the average of everyone trading in it. So before costs, half of all invested money must land below average. That is not pessimism. That is what average means. Now subtract the salaries, the trading costs, and the management fees. The professional's hurdle rises every single year, and 90% of them never clear it. An index fund does not try to beat the market. It quietly is the market at almost no cost. Which brings us to the number Wall Street least wants you to look at. The true price of 1 single percent. Secret number 3. 1% costs you a quarter of everything. Say you invest $500 a month for 40 years and markets average 8%. You finish near $1.75 million. Now add a friendly-sounding 1% annual fee, and your finish line drops to about $1.3 million. That single percent took over $400,000, roughly a quarter of your final wealth, for a number small enough to hide in a footnote. Make it a 2% fee, and you lose over 40%. The money does not vanish. It relocates from your retirement to their bonus pool. Advisors have a polite name for this: fee drag. Remember those 2 words, because they are the most expensive 2 words you were never taught. There is an old Wall Street story from the 1940s. A visitor to New York is shown the harbor, and his hosts point out the bankers' yachts and the brokers' yachts. And the visitor asks, "Where are the customers' yachts?" Nobody had an answer. Index funds broke that machine. The biggest ones now charge under 1/10 of 1%, which is exactly why when the first index fund launched in 1976, Wall Street tried to strangle it in the crib. They called it Bogle's Folly. One famous industry poster read, "Index funds are un-American." The fund hoped to raise $150 million. It raised 11. Today, that folly sits at the center of Vanguard's empire, which manages more money than almost any institution on earth. But cheap fees are still not the real reason boring wins. The real reason is standing in your bathroom mirror. Secret number 4. The index fund's true superpower is removing you. Remember rehearsal 3 from the last video? You make money decisions when you are weakest, and nowhere is that more expensive than investing. A famous study followed 66,000 households and ranked them by how often they traded. The most active traders earned about 6.5 percentage points less per year than the market they were trading in. The harder they worked, the poorer they got. Because every trade is a decision, and every decision is an open door for fear and greed to grab the wheel. Markets crash, you panic and sell at the bottom. Markets rally, you get brave and buy at the top. Everyone swears they won't. The data says almost everyone does. Researchers call this the behavior gap, the distance between what your investments earn and what you earn owning them. And a lot of people resist this truth for years because it feels like giving up, like admitting you are not clever enough to beat the game, until you finally see it clearly. Refusing to play a rigged game is not surrender. It is the winning move. So if boring wins this reliably, who is actually getting rich off it? That is secret 5, and they might be sitting in the cubicle next to you. Secret number 5. The millionaires are already among you, and they are spectacularly boring. In retirement plans run by one large American brokerage alone, more than 500,000 ordinary workers have become retirement account millionaires. Not founders, not traders, teachers, engineers, nurses, accountants. Their average path? Roughly 26 years of automatic contributions into broad, boring funds, straight through every crash, every election, every terrifying headline. A study of 10,000 American millionaires found the same pattern. 8 out of 10 built wealth through a workplace retirement plan, not the lottery, not inheritance, not crypto, payroll deduction. And the loudest endorsement comes from Omaha. One more time. Warren Buffett's own will, the instructions for the money he is leaving his wife, directs 90% of it into an S&P 500 index fund. The greatest stock picker in history chose the fund that picks nothing. So here is the entire playbook. 3 rules, and you could write them on a napkin. Rule 1. Buy the whole haystack. Stop searching for the needle. Buy every needle at once. A broad, low-cost index fund, total U.S. market, or S&P 500. The fee should be a decimal that starts with 0.0. Rule 2. Automate it. Same amount, same day, every month, the day after payday. Rehearsal 2. Flipped forever. And do it inside the tax-sheltered accounts first, your 401k, your Roth IRA, because the government quietly pays you to be boring. Rule 3. The hard one. Never stop. No pausing because an election is coming, and no waiting for the dip. The crash is not the exception to your plan. The crash is when your plan buys cheap. That is the whole system. No genius required. Which is exactly why nobody sells it to you. There is no commission on boring. Exciting investing sells because excitement feels like progress. But your account does not pay you for effort. It pays you for time, multiplied by consistency, multiplied by staying out of your own way. Boring is not the compromise. Boring is a strategy. So here's a question that should bother you. If wealth is really this simple, why are so many families still drowning? 2 paychecks, more education than any generation in history, more hours worked, and somehow less money left over than a family with one income had in 1975. That is not laziness. That is a trap built into the modern middle class itself, and almost nobody sees the mechanism. That trap is the next video, and it is on your screen now. And tonight, one action. Open your retirement account or spend 10 minutes learning what your options are. Find the broad, low-cost index funds inside it, then decide what automatic monthly investment fits your life. That is it. Your dollars just got the job we talked about last video. If you want the whole system, subscribe. No motivation speeches, no empty advice, just the mechanics of money explained clearly so you can finally use them. This video is for educational purposes only and is not financial advice. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Please consult a licensed financial professional before making investment decisions.